In this video we are going to talk about 7 dividend growth stocks. So before starting this video, please like this video and subscribe to this channel for our future updates. Even though their dividend yields appear to be mediocre, the finest dividend stocks, companies that increase their dividends on a consistent basis decade after decade, can generate higher overall returns over time. Number 7. Target Corp, ticker, TGT. On the basis of yield, Target is the option on the list, and it is also one of the lowest yielding alternatives available. In today's market, dividends paid on stocks amount to barely 1.4%. It is crucial to highlight, however, that there are two issues that need to be looked at carefully. In the first place, despite the fact that Target is a smaller firm, the corporation nonetheless generates a little greater rate of return than the S&P 500 as a whole. Furthermore, as a result of the stock's tremendous gain in value over the previous year, Target's dividend yield has declined significantly in recent months. Having a problem like that is not a bad thing to be dealing with. The firm has been able to boost its competitiveness in an increasingly e-commerce-centric environment as a result of a massive $7 billion digital investment that began in 2017 and continues to this day. Customer demand in 2020 shifted to companies that could manage online food and basic supplies, and Target was able to meet their pandemic needs as a result of the prior investment. Target has been able to leverage on its excellent earnings momentum throughout the year 2021, which has resulted in consistently outstanding quarterly results. Number 6. Greif Inc. Jeff. Greif is the smallest corporation on this list in terms of size, but it is also the most powerful in terms of influence. As predicted by the corporation, the packaging materials and containers producer would be in the appropriate position at the perfect time in the year 2021, allowing it to capitalize on opportunities. Increased consumer demand has resulted in an increase in the demand for a wide variety of packaging materials. Greif posted an astounding 38% growth in revenue in the most recent quarter when compared to the same period the prior year. Furthermore, earnings far exceeded expectations by a significant margin. The increase in input costs, such as the price of wood pulp, has put some strain on the business. Greif was able to increase pricing in order to alleviate these concerns, which was a huge success. Overall, Greif hopes to gain from unprecedented levels of consumption by American consumers. It also distributes income to its stockholders in the following ways. Jeff stock is currently yielding 2.6% on an annual basis, according to Investopedia. Number 5. Abbvie Inc. Abbvie. After making the cut in both 2019 and 2020, Abbvie is back on the list of the finest dividend stocks. The company has previously made the cut in both years. It is not difficult to see why this is the case. A unique dividend stock in a market when dividends are hard to come by, Abbvie stands out as a compelling investment opportunity. It is a fantastic investment because it is one of the highest paying stocks in the healthcare industry. Because Humira is the company's most profitable and successful product, Abbvie is unique in that it generates the vast majority of its sales and profits from it. In fact, for the past many years, that medication has been the best-selling pharmaceutical product on the market. Bears will refer to the company's potential for market share loss if Humira's patent expires in a couple of years, which they believe will happen. In order to broaden its product line, the firm purchased the rights to other drugs, such as Botox, which enabled it to thrive. Shares are currently yielding 4.8%, and given that the stock isn't predicted to increase in value considerably in 2021, now may be an excellent moment to invest in the company. Number 4. Johnson & Johnson, J&J. Johnson & Johnson is the typical example of a blue-chip stock in the United States. Generally speaking, the company's revenue and earnings increase by a tiny proportion each year on average. In order to reward its shareholders for their continued support, the corporation increases its dividend payment each year by a significant amount. Furthermore, it has now increased its dividend payout for 58 consecutive years, making it one of the few American dividend kings, or stocks that have increased their dividend payout for at least 50 consecutive years, now trading on the stock exchange. As part of this strategy, J&J operates a vastly diverse healthcare corporation within a unified corporate structure. Products ranging from Listerine and Tylenol to Pepcid and Band-Aids, among other things, are offered in the consumer goods industry. Pharmaceutical drugs are the company's most profitable business segment, however it also sells medical gadgets and other products. Hospitals will be unable to undertake elective treatments in 2020 as a result of the outbreak. After removing that obstacle, the company will be able to get back on track in 2021, making it a great moment to invest in the 2.6% dividend yield that the company is presently offering. Number 3. Iron Mountain Inc., IRM. Iron Mountain is referred to as a real estate investment trust, REIT, in the field of document and data storage and security, which is short for Real Estate Investment Trust. It had been a while since the company had been in a downward spiral because investors were afraid that a reduction in the use of paper documents would have a negative impact on the company's bottom line. In contrast, managers have shifted their focus to digital services such as data backup and data center operations, rather than on traditional services such as voice and data communications. Anyhow, Iron Mountain stock has rebounded from its recent dip and is on track to make new highs in 2021. However, stockholders continue to be rewarded by the firm, which currently pays a dividend yield of 5.2%. The REIT structure is one of the factors contributing to this. Real estate investment trusts, REITs, are able to avoid double taxation on their income because of their legal structure, yet they are obligated to transfer at least 90% of their profits to shareholders. Iron Mountain stockholders have benefited from this deal, which has shown to be mutually beneficial. Number 2. Discover Financial Services, DFS. Discover has earned a spot on this list of the best dividend payers since it is one of the highest yielding credit card issuers in the industry. Even though MasterCard Inc., MA, pays a dividend yield of only 0.5%, slightly higher than the yield on a typical bank savings account, it is the most profitable corporation in the world and pays the highest dividend yield. Explore Discover shares and how they can assist you in increasing the value of your money. Discover maintains a very low payout ratio of 20% in comparison to its earnings as a result of this policy, giving the company sufficient room to raise its dividend in the future if necessary. Having exposure to the credit card industry at this time is a fantastic opportunity for anyone. In response to the flu outbreak, the government and the Federal Reserve gave an extraordinary degree of economic stimulation, breaking all previous records. As a result, there has been an increase in consumption. It appears that people are beginning to recognize and enjoy the finer things in life, which will lead to increased spending on household appliances, household products and travel, as well as experiences in the year 2021. Discover and its competitors have witnessed a large boost in profits as a result of this development. Discover shares are currently trading at barely 8.8 times anticipated earnings, according to the company. Number 1. Mondelez International Inc., MDLZ. PepsiCo is one of the food and beverage corporations included on this list, which includes a number of others. Additionally, there is Mondelez, which manufactures a variety of household names such as Oreos and Toblerones, as well as Halls, Trident, and Tang, among others. Because of the outbreak, which drove people to stockpile food for their families, sales climbed dramatically in 2020. Stocks have begun to fall in value in 2021 as the benefits of the tax cut begin to fade and inflationary pressures on the cost side begin to emerge. Price hikes will not be tolerated by a food juggernaut such as Mondelez, which will emerge from this challenging period stronger than ever. The stock has only increased in value by a little amount over the past year, making this an excellent investment. Meanwhile, the corporation is paying a reasonable dividend of 2.3% on its stock. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.